These are the 3 S&P 500 ETFs Singaporeans keep pouring money into. If you are a beginner thinking of buying an S&P 500 ETF or wondering if you are still in the right one, I spent 12 days comparing 3 of them so that you can make an informed decision in 12 minutes. Stay until the end because I will review which one is my personal pick. The first S&P 500 ETF is the most popular among Singaporeans. If you search on YouTube, Reddit or investing blogs, this is almost always the answer. It is the CXPX. You might have owned it already but still learn something new here. For beginners, with the CXPX, you invest in the 500 biggest company in the US with just one fund. Nvidia, Apple, Microsoft, Amazon, Google. Technology makes up the biggest slice, followed by financials, communication, consumer discretionary, and healthcare. You don't have to do stock research. You don't have to monitor sector trends. You don't have to decide how much money to divide into each stocks. Just let the company fight among themselves for your hard-earned money. So why is the CXPX the most popular S&P 500 ETFs among Singaporeans? Here are 5 big reasons. The first reason is its fees. The CXPX expense ratio is just 0.07% a year. That is very low for its class. It gets deducted inside the fund, so you'll never see it leaving your account. To put it into perspective, for every $1,000 invested, you pay just 70 cents a year. If you invested $1,000 every month for the past 30 years, you will pay roughly $30,000. Now, I want you to remember this number because later on, you'll see how much the third ETF charges. But savings on fee means nothing if your money is quietly leaking in 3 other different ways. The second reason is where it is based. The CXPX is based in Ireland and listed on the London Stock Exchange. And that gives you 3 massive advantages over buying a US-based ETF like a VOO or SPY. Advantage 1. Less tax on your dividends. If you buy a US-based ETF as a non-US person, the IRS takes 30% of your dividends. With CXPX, because it is domiciled in Ireland, that drops to 15%. Advantage 2. No US estate tax. If you pass away holding more than $60,000 in US domiciled asset, the IRS takes up to 40% from your family. So not only do you die, your family with the CXPX, because it is Irish-based, it is not classified as an US asset. Advantage 3. Dividends are reinvested. CXPX is an accumulating fund, meaning dividends are reinvested back to the fund internally. So you won't need to remember to reinvest your dividends and pay extra trading fees. But being Ireland-based is not good enough if the fund closes down, or if you are overpaying every time you trade. The third reason is its size. CXPX has nearly 140 billion in assets, making it one of the largest S&P 500 ETFs you can buy outside the US. Bigger funds trade more, and more trading means tighter bid-ask spread, which means you pay less every time you buy or sell. To put it in real numbers, instead of paying 0.1% spread, that's $10 on every $10,000 trade. With the CXPX, you might pay just 0.01%. That's just $1 only. At the time I'm recording this video, CXPX spread is sitting at exactly 0.01%. CXPX has been running since 2010, over 16 years. Some funds providers shut down because they are unprofitable to run. But at $140 billion, that's not happening anytime soon. However, even if a fund has a small spread or is unlikely to shut down, it still needs to match the index performance as closely as possible. The fourth reason is its tracking error. The CXPX has a tight tracking error. Tracking error is the difference between what the index returns and what the fund actually returns. The smaller the difference, the more accurate it follows the index. Over the last 5 years, the S&P 500 index returned 13.69% a year. The CXPX returned 13.88%. That's a difference of 0.19%. If you add the 0.07% fee, which was deducted from the fund return, the tracking error was 0.26%. For an Ireland domiciled ETF, that's about as good as it gets. The fifth reason is long-term performance. Over the last 10 years, CXPX has delivered around 15% a year. But here's what you need to be careful. The last 2 decades was an unusually strong run, mostly driven by US tech and AI. With that said, you have invested $1,000 every month for the last 30 years. At the S&P 500 historical average return of 10% a year, you have put in $360,000 of your own money. Your portfolio will have grown to roughly 2.28 millions before taxes and fees. But remember, the market doesn't move in a straight line. In the past, the S&P 500 had dropped by 20% or even 50%. Whether the next 30 years will look like the last 30, no one knows. This is why you need to understand your investment horizon and risk tolerance before you invest. But wait, there's one caveat you need to be aware of: the price. CXPX is priced at over 700 US dollar per share. That's over 900 Singapore dollar just to buy one share. Now, interest brokers does allow you to buy fractional shares, so you can start with half a share or even just 0.1 share. But if you prefer to buy whole units like me, stick around, because the next ETF is not only priced lower, the company behind it is unlike any other fund company in the world. And once you hear it, you want to tell your friends about it. The second ETF is the VUAA. VUAA does two things very differently. Number one, the price. VUAA is priced at $130 per share versus CXPX at $726 at the time of recording this video. Much easier to get started with smaller amount. Now, interest brokers does allow fractional shares, but I personally like buying whole shares. It just makes it easier to track, and I don't want to deal with so many decimal places. And here's something most people don't think about fractional shares. If you move your shares from one broker to another, some brokers simply cannot handle them. I've been through this personally. Those fractional shares either get sold off or they are left behind. Now, the second thing VUAA does differently has nothing to do with numbers. It is about values. Most fund companies charge you fees, turn those fees into profit, and pay those profit out to outside shareholders. You are not the priority, your money is. Vanguard is built completely different. The fund owns the company, which means that as an investor, you are effectively a part owner of Vanguard. There are no outside shareholders pushing for higher fees. John Bogle set it up this way back in 1975 because he believed the whole industry was designed to profit off investors. It is a good feeling knowing that the people who manage your money are not profiting from you. The expense ratio is the same as CXPX at 0.07% a year. Same tax benefits and dividends are automatically reinvested. VUAA is also listed on the London Stock Exchange. Over the past 5 years, it has returned around 14% a year, nearly identical to the CXPX. So if I had to choose between CXPX and VUAA, which one would I personally choose? This is for my own situation. Your situation might be different, so always understand your own risk tolerance before deciding. If I'm already holding CXPX, I'm staying put. There's no good reason to pay transaction fee just to switch from something to another that performs almost identical. CSPX has been around for longer, it's a bigger fund, and the bid-ask spread are also tighter. If it is not broken, I'm not fixing it. But if I were to start fresh today, I would probably lean towards VUAA. The share price is lower, which means that I can buy whole shares without worrying about fractional shares. And honestly, I like that Vanguard is structured so that they are not profiting from me. By the way, if you are worried about US dollar falling, you might want to consider owning some ETF priced in Singapore dollar. In my next video, I will review the most popular Singapore ETF Singaporeans are buying, and I will review which one I will personally buy. Subscribe because you really don't want to miss this one. Now, what if I told you that there's another S&P 500 ETF that has an even lower expense ratio, an even lower share price, and also managed by a reputable fund manager, but it is not popular among Singaporeans yet? The third ETF is the SPYL. Let me explain the 3 reasons, and let's start with the biggest one. SPYL's expense ratio is just 0.03% a year. That's less than half the cost of CXPX and VUAA, with both charged 0.07%. Remember that $30,000 in fee over 30 years with the CXPX? Under the same scenario, with the SPYL, that drops to $13,000. You have saved over $17,000. Now, what good would that be if the share price is too high? The second reason is the price. SPYL is priced at just $17 per share at the time of making this video. You can buy one share even if your salary is modest. Compare that to CXPX at over $700. With the SPYL, you can put every dollar to work for you immediately. No saving up for months just to afford one unit. No fractional share decimal places. Now there's one caveat. SPYL was only launched in 2023. Newer funds tend to have a smaller fund size and a wider bid-ask spread. At the time of recording this video, SPYL spread is about 0.06%. Compare that to CSPX at 0.01%. On a $10,000 trade, CSPX would cost you $1 in spread. SPYL costs you $6. But for long-term investors who dollar cost every month or every 3 months, this likely won't move the needle much. Now you might think this fund is so new, is it still safe to invest? And this brings me to reason number 3. The fund is managed by State Street Global Advisor, the same firm behind SPY, the very first ETF ever listed in the US back in 1993. These guys didn't just enter the ETF space, they invented it. So yes, the fund is new, but the people running it have been doing so for 30 years. The SPYL is also listed on the London Stock Exchange. I personally use indirect brokers. Each trade only costs $2. Link is in the description. I may earn a small commission if you sign up, but it doesn't cost you anything extra and it helps me keep making free content for you. If I had to choose between these 3 ETFs today, I will pick SPYL because of its lower fee and lower share price. Now, I want to be honest with you. I personally don't invest in the S&P 500. The US has had a mega run in the last 20 years, but it hasn't always been the top performer. There were decades where international stocks outperformed US by a large margin. Nobody knows which one will come out ahead in the next 20 years. Do I think the S&P 500 will go higher over the long term? Yes, but here is my problem. I don't get to choose to retire only when the US market is at its high. I want to retire at a very specific window. It could be somewhere between 2040 to 2070. While I believe that if you hold long enough through every dips and crashes, the S&P 500 will eventually recover and go higher, I cannot guarantee you will have fully recovered during that very specific window. Now, instead of betting everything on US, I invest my money in a globally diversified ETFs. With that said, my global ETF still has 60 to 70% in the US anyway. Now, this is just me. I encourage you to think about your own financial situation. Maybe you are going to have other passive incomes like bonds or rental property when you retire. Maybe you think that when the America sneezes, the world catches a cold anyway. That is completely fine. Will I look stupid if America keep dominating? Yes, I will. But I'm not chasing the highest return. I just want to build a comfortable retirement. In my next video, I will review the 6 global ETFs Singaporeans cannot stop buying and which one I'm personally invested in. Subscribe now so that you don't buy the wrong fund. I will see you in the next one.